A financial system does not need to be stable to feel convincing. It only needs enough momentum, enough social validation, and enough uncertainty about the alternative to keep people participating long after the underlying logic stops making sense. And the strange part is how quickly that instability starts to feel like opportunity. By 2026, crypto bro is no longer a subculture. It is a behavioral pattern that keeps reappearing across different platforms, different tokens, and different narratives, always with new language but the same psychological structure underneath. What most explanations get wrong is assuming it is about technology. It never was. It is about attention, belief contagion, and the conversion of uncertainty into perceived asymmetrical upside, where cognitive biases do most of the heavy lifting. And this is where psychology starts to break down. Because the entry point is never framed as speculation, it is framed as inevitability. A quiet authority bias forms around early adopters who speak with unnatural certainty about cycles, halvings, and institutional liquidity, even when the concepts are being used as rhetorical shields rather than explanations. But what makes this even more unusual is how quickly social proof replaces evidence. Screenshots of gains circulate through group chats like experimental reinforcement signals. Each image acts as a behavioral trigger, reinforcing dopamine-driven reward anticipation loops in observers who were previously neutral. And this detail changes everything. The moment someone reacts emotionally to a gain screenshot, commitment escalation begins. Not through investment, but through identity alignment. They are no longer watching markets. They are watching themselves imagine participation, and that imagined participation becomes psychologically sticky through sunk cost anticipation, which leads to a far darker mechanism. Communities form around tokens, but function like recruitment networks. New entrants are not just buyers, they are propagation nodes. Each person recruited increases perceived legitimacy, creating a network effect where belief density replaces fundamentals entirely. And researchers notice something unexpected. The most persuasive members are not the ones with consistent profits, but the ones who narrate volatility as narrative progress. Losses are reframed as accumulation phases, which is a linguistic restructuring that neutralizes loss aversion and keeps engagement active even during decline. This is where cognitive dissonance starts to stabilize the system instead of breaking it. Because when reality contradicts expectation, the mind does not immediately exit. It edits the interpretation. A failed trade becomes learning. A collapsing chart becomes healthy correction. And each reinterpretation reduces the psychological pressure to disengage. But what makes this even more unusual is how authority forms without credentials. A wallet address with early timing becomes treated like expertise. A lucky entry point gets reinterpreted as predictive skill. Authority bias begins attaching itself to sequence, not competence. And this detail changes everything. Now, influence is no longer earned through analysis, but through timing history. Whoever entered early becomes structurally credible, even if their reasoning was random. The blockchain itself becomes a reputational fossil record, misread as intelligence hierarchy. Meanwhile, platforms quietly reinforce engagement loops. Notifications, price alerts, and group updates function like intermittent reinforcement schedules, the same behavioral pattern used in gambling systems. Each sudden price movement becomes a potential emotional spike, and unpredictability becomes addictive. But what makes this even more unusual is how entire communities begin synchronizing emotional states. When price rises, collective euphoria spreads through coordinated posting behavior. When price falls, shared rationalization kicks in almost instantly, as if the group is running a distributed cognitive defense system. Which leads to a structural shift. Tokens stop behaving like assets and start behaving like identity anchors. Holding becomes signaling. Selling becomes social risk. Even neutrality becomes suspicious. The sunk cost fallacy evolves into sunk identity fallacy, where exiting means invalidating not just a trade, but a persona. And this is where psychology starts to fully fragment. Because now every participant is managing two realities simultaneously, the market reality and the narrative reality. The narrative reality is usually stronger because it is reinforced by social proof loops, while market reality is noisy, delayed, and emotionally costly to accept. But researchers notice something critical here. The system does not require everyone to believe. It only requires enough participants to believe loudly enough to maintain perceived momentum. Belief becomes a distribution problem, not a truth problem. And this detail changes everything again. Influencer wallets, anonymous analysts, and meme-driven traders begin to function like authority clusters, not because they are accurate, but because they are visible. Visibility becomes a proxy for trustworthiness, and trustworthiness becomes a proxy for influence, completing a closed loop of perception-based valuation, which leads to escalation dynamics that mirror historical speculative cycles. Early entrants position themselves as enlightened, mid-cycle participants position themselves as strategic, late entrants position themselves as revolutionary. Each group believes they are operating with superior information, even though all of them are reacting to the same public signals. But what makes this even more unusual is how failure is absorbed into the system. Losses are rarely treated as disconfirmation. They are reframed as external interference, market manipulation, or temporary inefficiency, which preserves narrative coherence at the cost of empirical learning. And this detail changes everything again. Because when feedback stops correcting behavior, learning stops, but participation does not. The system continues operating as a belief engine rather than a performance engine, sustained by emotional reinforcement rather than measurable outcomes. At scale, this creates a paradoxical environment where skepticism exists, but rarely exits. People doubt privately while participating publicly, creating a split cognition state that reduces the friction of continued involvement. And that is where the loop becomes self-sustaining. Not because everyone is irrational, but because rational evaluation is structurally punished by volatility, social pressure, and the fear of missing the next reversal spike that might erase all previous doubts. But researchers notice something even darker. The most stable participants are often the most emotionally exposed ones because their identity becomes fully fused with the outcome trajectory of assets they do not control. And once identity is tied to a fluctuating signal, emotional independence becomes statistically rare. Which leads to the final layer. By 2026, cryptoculture is no longer defined by coins or chains. It is defined by a persistent attention economy where belief, visibility, and timing continuously reshape perceived reality faster than correction can stabilize it. And in that environment, the distinction between insight and narrative slowly dissolves until both are treated as the same thing depending on which one is currently going up. So the question is not why crypto bros keep appearing in every cycle. It is why systems built on unstable feedback loops reliably produce the same behavior patterns, even when everyone insists this time it is different. And somewhere right now, a new group chat is forming around that exact sentence. Already convinced they are early, already waiting for confirmation, already repeating the loop before realizing they are inside it. Anyway, if this didn't make you slightly suspicious of every guaranteed narrative online, you're probably already in one of them, like subscribe, and try not to get recruited by the next invisible cycle.